It has been a difficult couple of years for fixed interest investors. As interest rates have risen sharply, the price of bonds or fixed interest assets has fallen. And that's because the fixed rate of interest paid on all the outstanding assets in the market becomes less attractive as interest rates rise. Therefore, their price must fall to adjust and reflect the now higher rate of interest in the economy. And that's why conservative funds have done so poorly this year. So why have interest rates been rising? In short, it has a lot to do with inflation. Inflation has raced higher over the last year and now stands at its highest level in over 30 years. Inflation impacts interest rates because it erodes the purchasing power of money. That means when inflation is high, people will demand a higher rate of interest on their investments in order to be compensated for this. The good news is there are signs that global inflationary pressures might finally be easing. And what is most encouraging is that we are seeing this across several components of the Consumer Price Index. In areas like food, housing, and durable goods. Food security concerns have been causing prices to rise following the onset of war in the Ukraine and a poor start to the growing season in the US. But fast forward to today, and some key food producing nations like Australia and Brazil are suggesting a strong harvest in many of their commodities may now be on the cards. In terms of housing related costs, these tend to be quite closely linked to house prices. And although there is a lag here, rising mortgage rates look to be putting downward pressure on house prices, which is encouraging for bringing down inflation into the rest of the year. And finally, global supply chains are beginning to return to some semblance of normal. Freight rates are coming down, delivery times are improving, and channel checks suggest that production levels across a range of durable goods are bouncing back at a time when there is considerably more inventory in place.